Good morning. Excellent to start the morning with such an insightful panel. It's going to be an honor for me to be moderating the topic of today, which is ETF Unleash and how they are bridging the gap to a decentralized future. Before we start with pretty good questions, I would love for the fellow panelists to introduce themselves, their companies, and their story also in the ETF space. Perhaps we'd like to start?
Yeah, sure. Hello, everyone. My name is Rob Gaskell. I'm from a company called Appold. We're a blockchain advisory company, and we started our company in 2020. So we've been running for 4 years now. We advise institutions, blockchain protocols, and we've been tracking this market for a long time because we see the institutions moving into the digital asset space, and also the use of blockchain is becoming much more prevalent. So my interest in the ETF space, I'm not an ETF provider. I did used to work in the asset management industry, so I understand funds and exchange-traded funds. But what we've seen is, what we do is we are tracking this avidly for our clients, because some of our institutional clients and also some of the protocols as well like to understand what is happening. So we produce that in research reports.
My name is Kevin Blackburne, work at blockchain.com, CIO and financial strategy director there. Blockchain.com, I'm sure a lot of you guys are familiar with it. We started in 2012. It's one of the longest running crypto companies out there. Our flagship product was the Explorer for a long time, and we really sort of pioneered the non-custodial wallet. We have 90 million downloads, 40 million verified users. And now we actually have a full-fledged consumer platform and institutional platform. Consumer platform where you can buy, sell, hold, stake your crypto and connect to DeFi. And on the institutional side, we actually have an OTC spot and OTC derivatives and institutional custody and staking product. We really built out that institutional product for the last sort of 3-4 years. And we're seeing definitely a lot more excitement into both passive asset management and active asset management is how we sort of describe it. So the ETFs has obviously been a super big pressing point for that segment. And yeah, interested to see how it evolves and how it sort of changes the institutional landscape.
Yeah, hello. My name is Tim Bevan. I was CEO of ETC Group up until September this year. ETC Group was one of the first issuers of ETFs, or rather ETPs, in the European market in crypto. We were the first to be authorized by BaFin and listed on Deutsche Börse, and have the largest and most liquid Bitcoin ETP in Europe, physically backed Bitcoin ETP in Europe. I say was because we sold the business in August to Bitwise Asset Management in the US, and that's very successful ETF issuer and crypto asset manager in the US. So yeah, the story of Europe and the US, they've taken slightly different paths, and obviously when it comes to the depth and breadth of capital markets, Europe's a bit of a sideshow. But Europe has a range of product that's the most advanced in the world. We've got a lot more discretion in this geography as to what we can issue. A broader range of single asset products, index products, staking products, and beginning to see some structured or multi-asset products come through as well. So just from being a pure wrapper around an asset like Bitcoin, these ETPs are beginning to offer investment management solutions with a slightly more complex or maybe more interesting risk-reward payout profile.
Thank you, Tim. And as you can see, all the speakers in this panel are a league by their own. So we will be hearing from them and from their point of view in different angles. I would like to pivot to what you said, Tim. You were one of the first issuers. How was this process, in brief, in a few words? How was to launch this product? What was the experience?
Well, it's exceptionally painful. The European market, I don't want to go into too technical, but European ETFs are effectively UCITS funds, and UCITS is a regulatory framework, and there's absolutely no way crypto is eligible for that. But it isn't the first asset class that's had that problem. 15 years ago, people wanted to bring gold ETFs to Europe, but they faced the same issue, ineligible for UCITS funds. So a structure was created. Mechanically, it behaves like an ETF, but it's not a fund. It's a security that's 100% backed by the underlying asset. And we had the idea that this fitted well for Bitcoin. You take gold out of a vault, and you put Bitcoin on a cold server, and essentially the legal structure works. And we spent a lot of time, 17, 18, 19, going around Europe trying to find a regulator that wouldn't laugh us out of the room. We tried Sweden, where there were some products already listed, but were politely told the door was closed. The UK was a non-starter. And eventually we engaged with BaFin, and that was a year journey. They knocked us back 15 times, which was a personal best for the lawyer involved. But even sort of a third of the way through that process, we knew we'd get there in the end. And hats off to them. It's a big risk, issuing a product on a new asset class. And timing's everything. We got the thing lit in June 2020, and the market went gangbusters from sort of November that year onwards. So in that sense, we were fortunate that we hit that event then. It was very interesting launching into the European market. Undoubtedly, the vast majority of demand was retail. People seem to associate ETFs with institutional adoption, but really ETFs, well, in Europe they are, I think 60% institutional, but the crypto products really were absolutely dominated by retail. And you could see that from where the trade flow was going. And even back in 21, you could see as well that hedge funds were a big participant. So genuine institutional investors were not participants virtually at all. I mean, a few private banks, wealth managers, but really it was hedge funds looking to trade inefficiency out of markets, and there's crazy inefficiency in crypto markets, especially in TradFi world, because there are a lot of skews around capital and other rules, and retail. And interestingly, when the US launched at sort of beginning of this year, I think it's a similar story. You look at the sort of 13F filings, and it's Schoenfeld, it's Millennium, big holders, and largely retail. So institutional adoption's happening, but I think it's often slower than people care to admit. I think the ETF turning up provided an instrument that people could trade. It had a regulatory status, it had a tax status. But the arrival of the instrument's the start. Then the institutions have to do due diligence, they have to go through investment committees. This is a 6 to 12 month process. Even the wirehouses have only just started distributing the US ETFs in the last couple of months. So some people felt disappointed that we had this big furore, a lot of retail dived in, wow, biggest launch in 50 years, and it's felt like a bit of a damp squib since. Now part of that's the market, it's gone sideways. But part of that is really the ETF story needs to build steam, right? It doesn't happen overnight. And I think it's got a long way to run.
Yeah. Thank you, Tim. And I appreciate also the honesty, right? This is not something you find online. This is call through, coming from the call through from someone that has issued a product. And I would like to just extend on what you said about myth and what people see regarding institutional adoption. Are we perhaps making it bigger than it seems? And I would like to give the floor to Kevin and to Rob, because you're client-facing, right, and you're speaking with those clients every day. What is the before and after in regards to institutional adoption? What have you seen from the biggest traditional wealth managers and family offices and sovereignty wealth funds? What is their appetite? Are they here yet? Not yet? What is coming?
They're definitely getting there. We saw a big inflow in 2021, and to Tim's point, it takes a long time for these to get through their risk committees, their ICs. It would take, on average, for us to onboard a traditional finance institution about 14 to 18 months. So when 2021 happened, they were all geared up, ready to go, excited to trade, and then 2022, 2023 hit, they were on board and they didn't want to do anything. So to Tim's point, this stuff takes a long time. Like you mentioned, if you look at a lot of the 13Fs, it was mostly retail that came in and some asset managers. But I think they're still scratching the surface. They're still trying to get their mind around Bitcoin. I think there's a lot of waiting in terms of, there's still a lot of regulatory stuff to figure out. There's still a lot of, big events like, what the Fed does and what the elections do. So, I think it's kind of natural for them to be in this waiting game, and they're still sort of feeling it out and understanding what their options are and where they want to be exposed.
Rob, where are you?
Yeah, I mean, what we're finding is that, as Kevin has said, institutions and certainly some sovereign wealth funds have dipped their toe, but not actually gone full in a large way. I think that is slowly changing. There are some discussions going on right now with some of the largest sovereign wealth funds about large allocations of Bitcoin, seen as a hedge by those sovereign wealth funds. They're talking to many of the largest OTC providers right now to see how they could do that in a way that doesn't impact the market in a big sense. But that is not specific to ETFs. I did ask the question, why wouldn't they just go into the ETFs? Because that's an easy way for them to access it without necessarily the hurdle of having to look after keys and how they store this asset themselves and custody this asset themselves. But generally, they're looking at large allocations, and they're not comfortable potentially going in the ETF route. It gives them a way of obfuscating their holding in a way, so they're not necessarily wanting it to be fully open that we'd have to do through an ETF. But certainly, as everyone has said, it does take a long time. This isn't something that they all just rush in. They take a long time, a lot of consideration. They really need to understand what Bitcoin is and what it means, rather than just jumping in because one of their other institutions close to them has done it. This is much more considered.
And I appreciate that you said it takes time in terms for them to onboard and to transition to the space. Kevin, what do you think about the time that will take, or is taking also, for price to adapt for those new clients coming in? Have you seen, from an exchange point of view, a change in price efficiency, for example, or we are not there yet? What is your opinion?
A little bit. I mean, there's definitely more liquidity, and I think just given more access, it's made the sophistication of the markets a lot deeper. I think there was a little bit of, especially in 2022 and 2023, with a lot of sort of the institutional players going under and sort of the havoc that the price crash did. It became super illiquid for a long time. So for the back half of 2023, we saw those super illiquid markets. They weren't deep at all. It was very hard to take on risk because it was very hard to hedge it out. And 2024, you've sort of seen a resurgence, not just from ETFs, but just sort of OTC desks in general, which has made price discovery a lot better, has made these markets a lot deeper, a lot more liquid. And it's actually, it's funneling into a lot of not just Bitcoin and ETH, but a lot of like tail alts and stuff. So I don't think it's quite there, but it's definitely improved from where we were in 2022 and 2023.
I got a question myself, actually. I mean, have you seen a feedback loop from the ETF market in terms of consolidating liquidity into US market hours? And do you see a lot of pressure on that CF benchmarks fix, which all the US products seem to be benchmarked to?
Yeah, definitely. It's definitely increased. And we obviously, as most OTC desks, operate sort of 24/7, but there's definitely more concentration on the US side. There's definitely just more demand, more interest, it's definitely pricing closer and tighter for sure.
You hit a very key point here, and this is something we were speaking this week, concentration, right? If you see the treasury of BTC, if you want to call it that way, if you break it down of who are the biggest players and who is holding the most amount of BTC right now, the concentration is divided between MicroStrategy, Tesla, BlackRock, Binance, Satoshi, of course. But I wanted to, because this panel is all about bridging the gap to decentralization, I want to speak to hear your opinion on this matter. Is it truly decentralized? If the majority of BTC is now being held by BlackRock, MicroStrategy, and Tesla. How decentralized it is?
Well, I mean, there's quite a bit to unpack with that question, right? There's crypto as a tradable asset, and there's sort of distributed ledger technology as an infrastructure. The simple truth is DLT is not broadly networked well enough and utilized well enough by enough institutions and market participants at this stage. So the ETF's just a wrapper. It's just a means to access the underlying asset. So yeah, okay, there's a concentration on BlackRock, but how many millions of retail customers are holding Bitcoin through that? And if you look at the concentration due to ETFs, it's not that meaningful in terms of the sort of free float of Bitcoin. And I think over time, and I'm talking a long time, next 10, 20 years, most of financial markets infrastructure will move to distributed ledger technology. Tokenization will become sort of the de facto way of trading instruments, and it'll affect execution and post-trade infrastructure globally. And at that point, is an ETF relevant, right? I mean, an ETF for gold makes sense. You can't physically own gold bars, but there's nothing to stop you owning a digital asset. So taking a long-term view, this is a step on the journey, right? And it's an important step on the journey because without regulatory safe or tax-sure or operationally safe means of participating, we can't grow. We can't go to the next stage on that journey. So I think it's very positive. You're not going to get institutional participation to the degree you need it. And really for Bitcoin to do what it needs to do, it needs to be worth a lot more. Its overall notional value is too small to be a store of value. It can't be a payments mechanism. It's not efficient enough. So the thing needs to grow, and Bitcoin's on its own journey. And I think, when we're north of $500,000 of Bitcoin, then it can start to behave more in the way that we think its eventual use case will be as a store of value, as a collateral asset. So this is all work in progress, right? It's never really looking at in isolation, is this good, bad? It's part of an evolution. This kind of belief that the financial system would collapse and Bitcoin would save us all, it's a nice story, but it's not how things happen in real life, right? The whole market is going to evolve over the next 20 years. And a lot of this is going to be interaction, cooperation, and integration with the current system. And this is an example of it.
Yeah. Kevin, Rob, what do you think? Decentralization or heading towards centralization?
You want to go?
Yeah, so it's interesting that Bitcoin was started was basically a form of money on the internet, and it was started because of the failure of the banking side across the world during 2008 banking crisis. It looked like there was going to be a complete collapse of the banking system, but that didn't happen. But the technology was built out of that as a form of money for the people. I think that was the principle behind it. And I know some people in the space are on the Bitcoin purist side are not very happy with the way that the institutions are coming in and maybe holding large amounts of this asset. But at the end of the day, as Tim has said, this is part of a journey. I don't think it's a negative thing. I think it's a positive thing that people have access in different ways to Bitcoin, and they can start to see it as more of a store of value. I agree it's too small right now. It will grow, though, because the more people that come in, the more it will grow. There is a deterministic supply of Bitcoin, so that will have a big factor in its growth, whereas other ETFs or other types of assets, digital assets, don't necessarily have that programmatic supply, and that's going to be an issue for them. And we've seen that with the difference between the record-breaking Bitcoin ETFs that were launched in January and the more recent ETF being launched for Ethereum, which has not had the same sort of traction.
I think for me, it kind of depends what your end game of Bitcoin or crypto is. These two gentlemen have talked about the store of value. You kind of teeter between, is it a store of value or unit of account or medium of exchange? And I think if you want it as a store of value, then these ETFs are obviously great. And I think it leads to more access, more liquidity, more sophistication of the market. In terms of, these products are putting Bitcoins in a box and then selling those shares, selling shares of that box, which I think is a very different thesis to when we're talking about Bitcoin as the future of money or the future of this decentralized future. So I don't know, it depends on what you think Bitcoin can be and will be and what the ultimate goal is. And maybe Bitcoin is just supposed to be a store of value and people can get exposure to it and you're not supposed to do anything with it. And then the rest of crypto, of ETH and Solana and all these other great chains that are being built can sort of facilitate the other values and the other primary reasons of crypto and sort of that future of finance. So I don't know, I think it's a mixed bag. I think it's obviously indirectly a very good thing for crypto and a very inevitable and very necessary. If you want Bitcoin to be sort of this end-all be-all future of money and future of finance, it's probably not a great thing.
And we have
in some ways.
No, I couldn't agree more. And we have been focusing mostly on BTC and Ethereum, but Rob, you did mention those two ETF launches specifically. What is next? And of course, from your point of view, you do have quite good insights on the next few products or investment vehicles that are going to be launched. Do you think we're going to see more of those launches in Europe or perhaps more outcome-focused ETFs in the US? Again, no predictions, no investment advice. This is just what are you foreseeing in the next few months regarding the next steps?
Well, I'm not as well placed as Tim to mention this, but we did talk about this yesterday on options trading. Yeah. I think Tim can talk about that because I think that's gone a little bit under the radar, but effectively you can option trade on Bitcoin, BlackRock's Bitcoin ETF. That's a big thing. And in terms of what's next, then certainly some of the ETF providers are looking at other large tokens in the ecosystem like Solana and others. I think they'll probably
XRP
be next.
as well.
Yeah.
Well, XRP might have an issue because they've just had another problem with the SEC. So yeah, that might delay that ETF.
I know in Europe, again, going back to my earlier point, there's a very broad church of products you can issue. That is not the problem. The problem's demand, right? At the end of the day, when you're talking to a European private bank, wealth manager, they've been pushed by their clients, right? So they've been forced to find access products because they're getting hammered for not having some exposure to crypto in their portfolios from their ultra high net worth clients. Further up the chain, the pure discretionary or larger asset managers are probably a bit further behind the curve, right? This hasn't really hit the radar. It hasn't really passed the sniff test in terms of investability. So really we're at the stage of explaining the difference between Bitcoin and Ethereum. And that in itself is they're just fundamentally different assets. One's more akin to a tech equity and the other's more akin to commodity. So that's a big journey in itself, beginning to unpack what these different things are and how to understand them, how to value them, how to get a sense of what this investment is. So, we could issue a multi-factor WUWA deep in index product in Europe. No one would buy it. There's no demand. It's way too ahead of the innovation curve given the market you're targeting with an ETF, which is either retail or at this end, the smaller end of the institutional market. And if you've got a good total return staked Ethereum product, if you've got a good Bitcoin product, and maybe a benchmark index product, it's really hard to argue the demand case for going outside of, say, those three core products at this stage.
Yeah. Kevin, what are your thoughts on this?
Yeah, I think that makes sense. I've always said that, especially traditional financial institutions are sort of the most conservative, riskiest institutions out there, and it's intentional that they're kind of both because they take a long time to develop these theories and to develop these products, and they always wait for sort of regulatory green light, and they have to jump through a lot of hoops, both sort of governmental and for insider reasons and whatnot, but they're always willing to push the envelope, and I think Larry Fink and that whole crew are going to keep innovating and are going to keep pushing these products, and so I think you'll see more ETFs come out. I think you'll see more focus on altcoins. I think, going to the JP Morgan conference yesterday, there's this really interesting dichotomy of people that are interested in Bitcoin, sort of vanilla exposure to Bitcoin, and then want the craziest DeFi yield strategies out there, which is and nothing in between. Like, they don't want to hold Solana. They don't want to hold, market caps of 5 to 20. They're super interested in cash and carry position on Notcoin. And it's like, I don't know, it's super interesting of the interest levels and where the interest lies, even at an institutional basis, but getting there and getting regulatory clearance is probably miles away.
Wondering who is going to fill that gap, right?
I would say outside of Bitcoin, index products are going to be crucial. This is still a petri dish of experimentation, and a lot of these things are going to go to zero. Some will go to the moon. It's still early stage tech. And as an investor coming in, I don't really want to go down the rabbit hole of a deep dive into a bunch of different layer one protocols. I probably just want to buy a 10, 20 name index product and capture that general upside. So I think broader indices and then, thematic or subsector index products are the natural evolution of this market when it's big enough and got enough interest to support that product suite. But that would be a very obvious way for it to develop. It gives people a cleaner, more graspable investment case without having to go too deep, and it diversifies risk. It's a better investment product.
I think generally as well, we'll see it won't necessarily be the next token to be an ETF, but just bigger growth around Bitcoin ETFs. I think there will be more Bitcoin ETFs globally. In 2025, I predict there will be some quite large launches of Bitcoin ETFs into Europe and into Asia, much more so than we've seen recently. I think that's, even though, and we've spoken about this before, Tim, around the first mover advantage, but there are going to be different areas and different pockets of markets for Bitcoin ETFs, which we haven't tapped into yet globally.
And one of the biggest markets to be capped, which is APAC. APAC is still one of the biggest markets for some of the biggest exchanges. We haven't seen many ETFs there. So it's so early, I would say. What are your opinions, Tim?
Yeah, there's definitely movement. We hear Poland, Italy, and Europe this year. There's South Africa. There's movement politically, at least in South Korea, Japan. So yeah, I absolutely concur. There's going to be a much broader set of jurisdictions bringing product to market, ETFs or analogous products on TradFi platforms. And I think, in Asia, that could be super interesting.
And I would also like to highlight, I think many entrepreneurs focus a lot in Europe and in the US, but there is so much wealth concentrated also in CIS region, in APAC, that is yet to be uncapped because we don't have the amount of investment vehicles at this moment they can trade or they need. The potential is huge. It's something ourselves have seen in the last few weeks. How much wealth is still capped there? They're just waiting for the right vehicles.
Yeah, I mean, I think in the Middle East, they're quite happy trading US products. And that they look to US capital markets, as a lot of the world does. But I think the further east you go, there's a huge case for local products, especially in markets like Japan, for instance. But a lot of Asian countries, you need local product to bring the market to life. And I think that there's a huge untapped pool there.
Couldn't agree more. I think we do have a space for one or two questions. And I would like to kindly ask the audience if you do want to bring those questions live. I would love to give the word to Mark. Mark, please. Mark is, by the way, Jacobi Asset Management, the only regulator ETF in Europe. So.
Few questions for you, Tim, actually, at ETC. So right now,
There's a mic coming, so it might be, yeah.
That's better. Thanks a lot for all the information, and I think we've got an aligned vision of the market, the ETP space. A few questions for you, Tim. First one is in Europe, obviously, it's mainly ETNs that we have. ETFs are not fully regulated. Do you think that whenever regulators in Europe are going to follow the lead of the SEC and allow ETFs to be sold to retail investors and also qualified, do you think that could potentially unlock institutionals to say, okay, we might start considering it? Because as you said, and that's the same feedback we have, big asset managers right now, they're miles away to actually put proper allocation into it. So do you think there would be a change there?
I don't think so. I think UCITS rules are fairly intractable. I mean, here we are 15 years with gold and commodities, right, and nothing's moved. I know there's a sort of UCITS review, but I suspect even if something was going to happen, it's at least 5 years away. I don't think there's a problem with the structure, right? The structure's been around 15 years. It's held by institutionals, big institutionals when it comes to commodity products. The problem's the underlying asset, right? It's still very much getting comfortable with Bitcoin or Ethereum as an investable asset and the investment case for it. Europe's lumpy, right? So in certain markets, Germany, et cetera, retail can trade these things. In the UK, they're blocked. I think that will change over the next 12, 24 months. It's kind of indefensible from an objective risk basis. If I can buy a 3 times short NVIDIA certificate, but I can't go long Bitcoin. So, there are some, I think retail will generally get access across pan-Europe, and at the moment it's a bit jurisdiction by jurisdiction. Institutional just need time. There is a time factor, right? They need time to go through their processes, get comfortable, build internal levels of confidence to get to the point where they can pull the trigger. And it's not just getting comfortable with the investment, it's getting comfortable with a whole bunch of different risks, the operational risks, the credit risk, tax risks. I mean, it's a lot of work, and getting surety to the degree that these institutions need it, even now, is hard.
Second question, if I may. During the summer, ESMA asked for a call of evidence to add crypto assets into, eligible for UCITS. And I've seen also this week, I think 21 shares urged the regulators, also ESMA, to act on it. Will ETC Group follow the lead also, try to put a bit of pressure?
Well, I can't speak for ETC Group because I'm no longer with them.
Yeah.
That will be one for Bitwise Europe, as it now is, to decide upon. My personal view is too much too soon for UCITS. I think they'll look at it, and I think they'll take some learnings, but I expect that to be a slow coach out of the station. And I would be very surprised if crypto's UCITS eligible within a 5-year time frame. 5 years,
okay. Well, thank you.
Yeah. Mike, thank you. There was another question there, thank you.
Hi.
We might have space for one more after this, so.
Okay, thank you for excellent panel. Apart from regulatory issues and that education piece, as well as time taken for institutions to come into the crypto environment, what can the crypto industry do to help bridge that gap and help more institutions come into the space?
I think it's confidence, right? I mean, obviously confidence was badly shaken in 22, 23, and, who knew an unregulated retail-dominated market would attract bad actors? But, it still has this sort of stop-start, crazy fly-by-night reputational issue. And one of the biggest blocks is the personal risk, reputational risk premium senior individuals at institutions have to put on the table to say we're moving into Bitcoin or crypto. It's really that personal reputational risk premium that is often the blocker. So I think, again, the industry's come on so much over the past 18 months, 2 years, but that needs to continue. Governance is important, assurance is important. These aren't just old-fashioned TradFi things made up to be fuddy-duddy. They're really important, otherwise things go bad and go wrong. And there's certain bits of TradFi that need to be embraced, right? This system's developed for 200 years. It exists the way it exists for a reason. Not everything needs to be broken and chucked out the window and replaced with crypto. So I think better governance, better assurance, better processes, just less bad things happening, and just a more adult, grown-up approach will improve the reputational standing of the whole industry.
Yeah. Just to clarify that, when you say personal reputational risk, do you mean of the founders?
Of senior managers, it's a classic example. You got Jamie Dimon standing up saying, "I hate crypto." There's a bunch of units in JP Morgan working, beavering away in their secret labs to be ready for crypto. And that's replicated across a whole bunch of institutions. No one wants to be the guy standing up saying, "I support crypto," because he's going to get shot down by his peer group. In the back of their heads, they've all got it going on behind closed doors. Why is it behind closed doors?
Apart from Larry Fink, obviously.
Apart from Larry swallowed the orange pill in a big way. And honestly, you can't ask for a more influential supporter than him. It's been a big, from an individual perspective, one of the biggest steps forward for the whole industry, I think.
I think one thing for me is, in crypto in general, I think another level or innovation of utility of it would go a long way. I think that's the biggest divide when I talk to people from traditional finance of like what's the so what of all this, right? If you just want exposure to this thing that goes up and down, but there's no real use case, and maybe again the use case for Bitcoin is just a store of value, but I think with crypto, like one of the biggest examples of like what Aave and Compound are doing, I think those are like amazing protocols and have really possessed and leveled up a utility of this over collateralized lending and can actually use this to facilitate different things. And I think we've kind of been stuck in that rut a bit of what is the next level of innovation. And it's fun coming to these conferences and meeting all these super cool companies and protocols that are building that exact level of innovation, but bringing that innovation to sort of traditional finance and real world application, I think is kind of the next level. Again, that's probably more for crypto in general and less sort of Bitcoin focused.
And Rob, what's your view on this?
Yeah, getting back to the ETFs, I mean, there could be products around the ETFs. There could be products within the ETFs that could become more interesting and maybe drive some of that adoption in the decentralized finance area. The decentralized finance area has kind of stagnated, I say, a little bit. There's a lot of still more innovation coming, but they haven't got the traction that you can see from other areas of the industry. And I agree, we need some serious applications that are being used by institutions to start to drive further adoption.
Thank you so much, Rob. Sadly, the time has come to draw the curtain on this great panel. I assume you will be around trying to connect with some of the audience. So please, if you do have more questions for Tim, Kevin, and Rob, you can approach them in a few minutes outside. And thank you so much. A big applause for those speakers.
Thank you.